Hey there, today we have a deep dive and this is a little bit different. We're doing a great debate against young pups in the office against old man Phil. Talking about, do we need insurance when we are young? Is it a waste of money or not? So we're going to do a debate. So today I got Seb and Ruby. Thanks for joining me, guys.
Thanks for having us.
Yeah.
So now this is a debate. Now, one of the things that Seb, you got a lecture week 2 or 3 from myself.
Yeah.
Why you need insurance, and then you enjoyed the fact that you had other young people and you set everyone else up to get a lecture.
I did throw them all under the bus.
So we thought we'd do a video because it's a common thought. Do I need insurance when I'm young? So we thought we'd do a debate, and we've got boxing gloves. So me and Ruby, let's go. Game on. So come at me. What's your first point, Seb?
Cool. So for context, we are arguing against insurance just for content for the video. So
Okay.
all right.
Yep.
Point number one. So
Point number one.
I'm young. I'm 21 years old. I haven't been working for long. I was self-employed for the past year and a half and was not making superannuation contributions. So I have a low super balance. And if I take out insurance, I'm going to lose any potential compounding growth and have no retirement savings.
Yeah, good point. So insurance policies, a lot of it can be funded through your super fund. So yes, the impact on your super balance over the long term is important to think about. One thing that I like to think about is people always like to think about compound interest and the compounding impact on your super balance. And one question I have is, when you get takeaway food, Seb, do you think about the compound impact of if you don't spend that takeaway food and you invested it? Have you ever thought about the compounding impact of that?
No, I do not.
So the compound impact of your Macca's bill
Goodness.
over your lifetime, and if it was invested, would be millions and millions and millions of dollars. Maybe not Macca's, maybe Macca's isn't your thing. So I appreciate the super money sitting there. We can't use it for anything other than insurance. We can't just pull it out, but you can just stop getting junk food and put that money into super, and it offsets the impact on your super balance.
Cool. Yeah, I'll stop getting Macca's then.
Well, there you go. Well, we should, yeah.
Yeah.
So yes, it does have an impact, but superannuation is long-term retirement planning. And so you're not going to touch that until you're 65, 70, depending when you guys get there, maybe 80, maybe the age of which you can touch that super. And so if something happens between now and then, think about the compounding impact on your super if you couldn't work. And that's really what insurance is about making sure you are protecting that compounding impact. Because if you can't work for 2, 3, 4 years, any time during your working life, that has a massive compounding impact as well. So yes, premiums cost money, but if you ever need a claim on it, then it'll offset any of that, the downside of the premiums. But good point.
Yeah, great. Rebutted.
Yeah.
I'm done.
Ruby.
I'll try. I'm a little bit older than Seb, but I'm single, have no dependents, don't have a mortgage. I feel like there's no point.
There's another common point. Actually, you did this the other day when we talked about this, is do you know the compounding impact between now and age 65 of your current income?
We did, yeah, I worked it out.
Do you remember what the number was?
It's around $4 million.
$4 million.
Yeah.
And so this is something that for young people, one thing I often talk about is like, at the end of the day, your income, assuming you don't get any pay rises other than like inflation, your income is worth $4 million. So your ability to earn an income is $4 million. And so being young means statistically less likely to claim on the cover, but the actual insurable amount is $4 million. And so that's why, I believe income protection is really important to have, is because yes, you may not need life insurance based on your current life situation. Disability cover and trauma cover are really important, but income protection is the most important, because if you had a house worth $4 million, you'd insure it. If you had a car worth $4 million, you wouldn't drive it. You'd probably sell it if you're being smart. But you can't trade your ability to earn an income for another asset. So you've got to be able to earn that income. And that's why insurance is incredibly important.
For sure.
Any rebuttals? Go.
I do have one. Do you think that people are not educated enough about insurance then, because they just assume that it's life insurance and that when they die it's meant to go on to their dependents, and they don't know about income protection?
Yeah, I think there is definitely education barrier, understanding what are all the personal insurances. Like we kind of like when you buy a phone, like people get phones when they're teenagers and, you know, there's like insurance on your phone. We kind of all have heard that because someone at Optus or Telstra try to sell that to us for, I don't know, $5 a month or whatever it is. So we understand that concept of insurance. Income protection is, you know, misunderstood. Well, not misunderstood, just not understood at all. And I think a portion of that is potentially a lot of super funds set up insurance policies when it comes to personal insurance cover, like life and disability and income protection. So there isn't this understanding of, oh, maybe it's something I need to actively go and do because it'll get sorted out, which is actually a point that I didn't even prepare, but that's actually a point that I have as to why you should get it, but I'll save that point till later. I got to write it with my left hand what my point is. Yeah, so that's why I think there is a lack of education, but I mean, there's so much for us to know about. Insurance is one small aspect of a busy life.
Yeah.
We're all busy. Yeah. Seb, what do you got for me?
Okay, next point. So this topic is one of the biggest topics in the financial advice industry. Everyone's talking about it. The intergenerational wealth transfer.
Oh, okay.
So I don't need insurance because I can rely on, as bad as it sounds, as bleak as it is, I can rely on my family and inheritance in 20 to 30 years.
It's a good point. Me personally, I'm inheriting nothing. So I think a lot of people will not inherit maybe as much as they want. And I actively encourage my parents to spend everything because I just don't want to deal with my siblings talking about money. It's like they spend it all, enjoy your life, you deserve it. But there are some people who are fortunate who come from, you know, wealth and that can rely on that. My thing is that you just recently moved out of home.
Yeah.
And when you were 20, you moved out.
Yeah.
Now, how was, you know, you love your parents, you got a great relationship with them, but how was living at home as a 20-year-old single, not married? Was it okay? Was it great? Was it not ideal?
Can't complain.
Yeah.
It was good.
Good. Now, if you had, now you have a wife, how do you think Abigail would go living with your family or both of you living at home? How do you think that dynamic would go? Without throwing Abigail under the bus?
I don't think it's ideal for the long term.
I don't think it's ideal either. Now, think about, you know, you guys have 2 kids and then, you know, then how would you go being back at the family home? That's when it becomes even tougher. I lived, you know, with my in-laws when we had kids. We were saving for a house and it was great, big house, lots of room, but it is not a long-term sustainable option in my view. I would happily pay $1,000, $2,000, $3,000, $10,000 to not have to deal with that. I love my in-laws, but it's not a sustainable option. It is an option if you're desperate, for sure. It is something if you don't have insurance and you are injured, ill, sick, unable to work, great, you've got that security. But it is not something that I would love to rely on. And we ask most of our clients when they talk about it, it's like, at the end of the day, would you want to live with your in-laws or live with your parents as an adult and needing their support? Most people say no, they wouldn't want to. Even it doesn't matter how good your relationship with your parents are.
Cool.
Yeah.
There you go.
Okay, next point is the economy is not great. So I would just want to spend money on something else other than insurance, like saving for a house, for example. Also, there's insurance already in my super. So I'm already paying for it at some capacity.
Yeah, and so there's 2 points. The cost, cost of living. Can I afford it? You did a quote for yourself.
Yeah.
Talk to me about the cost of that quote. Now, this is, you just put it through our calculator. Yeah. No loadings, no exclusion. We don't know what the actual outcome is, but just a standard quote. Yeah. What was the cost for your cover when you put it through the system?
It's actually a lot cheaper than I thought. It ended up being just over $1,000 a year.
$1,000 a year? Yeah. And how much of that was through your super fund?
Majority of it.
Yeah.
Like $22 a month was outside of the super.
Yeah, 22. So $5 a week, $7 a week, $6 a week. Can't do the math. I'll get there. Now, yes, the cost of living is an impact. We've got to pay these premiums, but that's full coverage. That's income protection, life insurance, disability, trauma insurance. Yeah. And so, back to Seb's point, yes, it has a cost on, the compounding interest on your super fund, and that needs to be factored in. So even if you were to pay for the full amount, you're talking, maybe $800 in pre-tax income to fully fund the premiums. It is something that you need to prioritize and think about. But the thing that I look at is, do you want to pay, your $6 a week outside of super to minimize the chance of if something happened, you've got the financial security there to be able to pay bills? And because really that's what insurance is about. It's certainty. Gives you certainty to know that I'm not begging, I'm not doing a GoFundMe, I'm not doing any of that stuff. I've got the money in the bank account to be able to pay for what I need to. So yes, cost of living is an impact. But do you think, legitimate question, personal question here, do you legitimately think you could find $6 a week, or you're overspending $6 a week in areas that maybe you don't need to?
No, I could find $6 a week. I'm just stubborn and want to save for something else.
Which is fair enough.
Yeah.
And again, in this great debate, my thing would be, if you can't work or you're unable to work for any period of time, 2 months, 3 months, 2 years, whatever that is going to be completely offset. The loss of income will be completely offset by the insurance premiums that you're going to pay in that period of time. And that's where insurance can kick in. Look, we're having a debate. I'm being a bit more obnoxious to you guys. But at the end of the day, you all make your own personal decisions. My thing is that I get frustrated is people, this I don't mean it to sound insensitive, but cry poor when something goes wrong, when you could have just set up insurance policies. And that's kind of the frustration is, yes, we've got to have empathy if someone's in that situation, and we've got to be generous and make sure we're looking after, the people in our community who need it. But there are these insurance policies you can set up, but you've made a conscious decision not to protect yourself. And that's kind of the difficulty, is because we see people claiming, we see people in a situation who need the money and they either don't have it, or, maybe it's not enough. What do you got for me, Seb?
Okay, it's my last and final point is, I'm young, I'm the healthiest I'll ever be. Why do I need to get insurance when I'm not going to claim?
Great point. So that's the reason you need to get insurance now, because you're young and you're healthiest you'll ever be. So from an insurance point of view, one of the great things is it's set up today. It can't change. If your health changes and gets worse in the future, well, your policy that you set up today goes on till you cancel it, basically. So that is actually the reason why you should. That's my point. So thank you for giving me a point. Because, you want to set up your policies before any health issues happen, well before that. Like, it doesn't even need to be major health issues like cancers or anything like that. It just needs to be before you have any issues that will lead to an exclusion when you get cover. Because, that's the thing that we see a lot is exclusions and loadings because of health impacts. So when you're young and healthy, that's when you should get the policy, because you'll get the best policy possible.
Yeah. So why don't I just set it up right before a health event?
Well, great. Tell me what date that health event's going to happen, and then I will tell you that's the 100% the best time to set it up is just before the health event, and then second best is today. And so that's why you should definitely get covered today.
Cool.
Any more points from you, Ruby? Well, you reached out to your friends to see what their concerns are.
That was really interesting. A lot of people maybe were just a little bit uneducated about life insurance. They knew that it was coming out of their super and that there was some sort of insurance that they already had. A lot of them argued that they couldn't afford it. Like one person even said that they can't afford health insurance at the moment, so why would they get life insurance? What else?
Do you want me to argue that point about health insurance? All right, I actually emailed an insurance. I got to take this glove off to get in my computer. So I emailed an insurance company who does a cost of care report. Zurich is the one who does the cost of care. And they, I'll show you guys in a second, but they do, a part of their cost of care report is, what's the average cost for any one condition? Like, prostate cancer, what's the average cost? Breast cancer, all this, it's 163 pages. It's a big report. It's got heaps of data, well-researched data. One of the things that I looked at, I remembered going into a PD, professional development session, and they showed a stat about that individuals are the third largest contributor to medical expenses. So on an annual basis, individuals are paying $33.7 billion towards medical treatment. Number one, who's number one? Did you see it on my computer?
No.
Have a guess who's number one.
I want to say GoFundMe.
No, not GoFundMe. No.
Wouldn't have a clue.
Australian government.
Oh,
They're the number one.
Yeah.
They fund the most, hospitals, treatment, all of that. Number two is state governments. Number 3 is individuals. And number 4 is health insurance providers. So we're paying premiums for health insurance when we're actually paying twice what they are. So health insurance providers fund $17.5 billion towards medical treatment and cost, when individuals are paying $33 billion.
That's crazy.
So this thing about, well, I'd prioritize health insurance over life insurance. My argument is, well, health insurance is really expensive. And of course I'm conflicted. We do life insurance, and I strongly believe in it. But for me, life insurance is much more important because it can replace my income. Health insurance doesn't do any of that. Health insurance, if I have a diagnosis, there's a lot of money that hits my bank account if it's a claimable event. And so individuals are paying heaps more than health insurance providers, and people think health insurance providers are eating a bit. So what was some other concerns that your friends had?
Yeah, just the cost of it.
But back to your point, you said, I didn't realize it was going to be as cheap as it was.
Yeah.
Yeah, I did my quotes as well.
So tell me yours.
For me, it would be just over $1,500 a year.
And the reason, I mean, there's an age gap, and there's a whole bunch of things that comes into pricing, but you've got a mortgage now. Yeah. So you've got your cover will be higher because of that.
Higher cover, yeah. About $1,200 from super and $31 a month from
$31 a month
cash flow.
Now, Seb, I've got a personal question for you.
Yeah.
How much are you spending on junk food a month? Less or more than, more or less than $31 or $32?
Just a little bit more
Just a little.
than $30.
And so unnecessary junk food. I'm not talking about dinner. Like if you're going out for dinner, unnecessary, where you could go, I could easily not do this.
Yeah, a lot more than $31.
So there's money there.
Yeah.
That isn't going towards your super balance. It isn't going towards investments. It's not going towards paying off your mortgage.
Yep.
You're just throwing that money away on junk food.
Yep.
That could go towards insurance.
Yep. And I guess to debate my own.
Yeah, good. Come on my side of the table.
For my first point with the superannuation, it would only cost me $27 a week to totally negate the whole cost of it
in salary sacrifice. So when we talk about salary sacrifice, is that any impact to your take-home pay, $27, or is that
I would reduce my pay by $27 a week.
Okay. And what was the monthly? Like, let me work out what's the total weekly cost. We're talking about like $35 a week in reduced income and cost. Yeah. Okay. Great. I'm so glad. We'll do the application. We'll get it done by end of the week.
Yeah.
and I mean, Seb, one thing that you've got to tackle with is, now you're part of a household where I'm going to make a whole bunch of assumptions, but now it's a household income. So you've got to make a decision that, is best for both yourself and Abigail and work out how do we navigate that. And so it's just like with all household spending, it's not just, you can't just go and say, I'll get it done, all good. You've got to discuss, is that important as a household?
Yeah.
The other point I had is about being young, and my super's got it covered. Superannuations don't set up default cover if you're under 25. So if you're young and you're under 25, your super fund won't have any cover set up for you. And so, that again, it's a misunderstanding that, my super's got it sorted. The government actually came in and said under 25-year-olds don't need insurance, which is wild to me, but they did. And so, being young, under 25, you're not going to have that cover set up through your super fund as well. So you need to set it up yourself.
I did not know that.
Yeah. Any other rebuttals, discussion points, anything that we missed?
I do have one. My mum and dad actually did have life insurance when they were younger, and they didn't pay one time, and the whole policy got cancelled. And then the company wouldn't take them back on. So then they were like, and they thought that was like pretty disappointing. They'd paid like every month prior to that, and then they missed 1 month, and it was cancelled straight away. I
mean, obviously without knowing the situation, that wouldn't happen today with any providers that we look at today. They often give like a 3-month grace of no payment before then it will get cancelled. And then to reset up the policy, you got to go through the whole application process again. You obviously, I don't know the situation.
I don't know the whole story, but that's what Mum and Dad said. So.
And sometimes, like, you know, these bills come annually, so you just forget that it didn't get charged. When you're older, you got kids, you don't look at your bank statements every day to work out what's coming and what's going. And so if you get a decline and you don't read your letters, like, life's busy, it can happen. And
they
so
had
it is
5 kids growing up.
Yeah, it's easily something that can get missed. So that's why, like, these insurances are super important to keep on top of. Once I thought I forgot to renew my car insurance after a car crash. I had the crash and I just couldn't find it in my emails. I'm like, who the heck is our insurance company? Because I need this, and I freaked out that I wasn't insured.
Yeah.
That's scary.
Fortunately,
that's
I was.
a heart attack.
Yeah, you're right. And then that's why personal insurance is important, because if you have the heart attack, you've got insurance as well.
Yeah, that's smart.
But I mean, to wrap up my point, the purpose of the insurance is, I mean, actually, my other point, here's my point. I woke up this morning and I got on Facebook or whatever social media, and literally one of the first things that came up was a 27-year-old diagnosed with breast cancer. And I was like, you young whippersnappers telling me that young people don't get sick? No, they get sick. We've got clients who are on a long-term, we've got a client who was going to check how old she was. I'm going to say definitely under 30. I'm going to say 27, I think. Got COVID. And then has had kind of like long COVID, but more like chronic fatigue type symptoms, and has been on a partial income protection claim for, I'm going to say, 4 years now.
Whoa.
And still receiving partial payment. And her story is even more interesting. We tried to get cover, income protection. She changed jobs, uninsurable, and then she was proactive about going, I couldn't get it then because I had a change of jobs, but now I can. Let's get the income protection policy set up now. So we went and set up the income protection policy. And then, I think 12 months later, went on claim and has been claiming on it ever since. So she was proactive. She started the process when she was 25-ish. And, young people get sick.
Yeah.
It's not nice to think about. The other thing you mentioned was, insurance is a scam for young people.
Yeah.
Hopefully it is. Like, that's the other thing. Insurance is, I'll put my like lefty hippie hat on for a bit. Insurance policies are community services. At the end of the day, insurance is, we all put money in this bucket, and then someone in the community is sick, they get to go and walk to that bucket and pull the money out. And so we all think insurance companies are making bucket loads of money, and they're not. They're like, especially for life insurance, it's the least profitable insurance in Australia, because they're paying out a lot more in claims. They're not paying more in claims than they're receiving, but they're on a percentage basis, they're paying a lot compared to like general insurance, which is car and house or health insurance. Life insurance companies pay more on a percentage of premiums. And at the end of the day, it's a community service where we all put money into this bucket. When you get sick, Seb, which we hope never happens, you get to pull the money out of that bucket. And so that's one of the kind of mindset shifts I try and think about is, when I pay my premiums, what am I paying? I'm paying for someone else to use that money. And if I don't use the money, that's the best case scenario. I don't want to use the money, but I want to make sure it's there for someone else. And everyone just looks at the insurance company name and thinks, well, they're the bad guy and they're not going to pay claims. Claims get paid at massive percentages, and so it's a community service. So if you're going to be cheap, think about the billions of dollars that get paid out to other people who need it.
That's a really good way to put it. I actually that's probably my best takeaway from this. Community service is always nice, and giving back is an amazing thing to do. So
and you can look at it, it's all public data, how much insurance companies profit. There's not much money. A lot of it's going out in claims. And so, Anyway, any other points?
No, but it'd be nice to touch on like that stereotype that I think a lot of people fall victim to believing. Even I did before I became educated about
Before you got lectured.
Before I got lectured. Before I did research, is that insurance is a scam, and the insurer companies will do anything they can to reject a claim, and that they're the big old boogeyman, the bad guys, and they just, I guess, pool all their money. So
and I'm sure Pete will write it down to put in a link in the description of this video about the claim statistics. One of the great things is insurance claims are all public data. The regulator pulls that data and publicly displays it on MoneySmart website. And so you can see the claims acceptance rates. Now, one thing that's a little bit disappointing is you can't see the average claim amount. So But you can see the acceptance rates versus if your policy is set up with a financial advisor versus a super fund versus direct. And so you can see the claims acceptance rates. Income protection is over 95% of all income protection claims are paid out. Life insurance, it's like 98.7%. Why is it not 100%? Good question. The reason because you can get like early termination, like terminal illness benefits. And if someone's not properly terminally ill or fully diagnosed, then that'll get declined. And fraudulent claims as well. But the acceptance rates is incredibly high because it's insurance. Insurance is insurance. But like you'd look at like house and contents insurance versus life insurance, and they all get grouped together. The thing about house and contents insurance is those providers, based on the General Insurance Act, those providers can change their contracts every year, every renewal. They've got the ability to change it. So if you live in Brisbane, you're near the river, because of the major floods, they can remove flood damage from their contracts on renewal. And so that's why, when another flood comes, people aren't insured properly, then we all see it in the headlines, or the fires in Victoria, or floods in Queensland. That's because the way those policies are structured allows an insurance company to tinker and change. Whether it's good or bad, we can discuss, but they're allowed to do it, legislatively allowed to do it. Life insurance providers can't. They can't tinker with their policies, which is hard in lots of ways. But if they cover you and they say you're going to cover you for A, B, and C, and you own the contract, then nothing can change with that contract. And that's legislatively. And
is that different with owning a group policy?
Yeah, good tee up, Seb. Appreciate that. So owning a group policy through your super fund is the super fund owns the contract. So the super fund can change the terms and conditions of the contract over time. So, something like Australian Super changed their TPD definition from, are you unlikely to return to work again within your TPD definition? So unlikely. Then they changed it to unable to. So meaning that you've got to get two doctors to say you are clearly unable to return to work again versus unlikely. If doctor would sign an unlikely much sooner than they would sign an unable. And the super fund owns the contract, so they can make those changes over time. They can change the waiting periods and the benefit periods. They own the contract. But if you own it directly, which you guys will soon, set your own policies up, and your super fund can still pay for it, then they can't make a change to the contract other than the premiums. They can increase that.
Cool. Yeah, great.
Awesome.
Nice.
Thank you, team. Now, my final question, Ruby, are you going to get insurance?
Soon. Yes.
Soon.
Yeah.
And you don't have insurance yet?
No, I don't have insurance.
All right, next question. Seb,
yeah.
You married?
Yeah.
Have a mortgage?
Yeah.
Surely you've got insurance, don't you?
No, I do not.
All right, we'll change that. Are you going to set it up soon?
Yeah, soon.
Good,
As soon as I can get everything right in the household and kind of convince all the board members.
Well, bring the board members here, and I'll lecture Abigail enough to just say, don't rely on mummy and daddy, bank of mummy and daddy, because Abigail does not want to live with your parents. I don't know the relationship. I'm sure they're all good.
She does love mum's cooking.
I'm sure she does, but live there for 10 years. If either of you guys are staff, no, she doesn't. All right, awesome. Cool. Thanks, guys. I appreciate it.
Thank you.
Well done, Ruby.
Good game.
Well done, Seb.